Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. It's just now to go down until the closing bell, and stocks mostly lower here. It's after initially popping on the back of those GDP and PCE readings. Join me now to help make sense of these market moves. You got Ayoko Yoshiaka, Wealth Enhancement Portfolio Consulting Director, and Yahoo Finance's Jared Blickery. Welcome to you both. Jared, my friend, let's start with you. Help break down the markets. What are we seeing?
Let's go to the Wi-Fi Interactive. As you said, key line here, the Dow started out the day in the green, as did all the major indices. It has now drifted into the red. And why I think this is important, it is a multi-day pattern here. So this is the S&P 500. Here's all 5 days this week. Now look, on Monday we did go up, but guess what? On Tuesday we ended up, after an initial pop, net down. Here's a pop on Wednesday, net down. Here Thursday we started underwater, ended underwater, and Friday we started up a little bit, ended down. This is a drastic reversal of what we saw earlier in the month when we were selling off earlier in the day, and then we were recovering into the close. And as I've been harping on, here's the S&P 500 key line, 6,800. This is year to date. We came down and then we retested it, kissed it, and then we were off to the races to the downside. So that is the main story right here, is that equities, stocks have something to prove. Now let's take a look at the large cap sector action. We do see some green, but it's mostly defensive. Here's utilities, that's up 1.5%, followed by what? Consumer staples, then real estate, then energy, then financials, healthcare. Everything except for financials, arguably a bit defensive here. And then what's not working the most today, materials, tech, and also communication services. Throw in consumer discretionary, that's basically the mega cap complex right there. Over the last 5 days, only energy and utilities in the green. Meanwhile, retail stocks, discretionary, and financials taking a hit to the downside of about 3%. Industrials right there with them, and then communication services a distant fourth. And you can really see this showing up on the Dow tape this week. We do see some green, but these are, again, largely defensive names. Home Depot down 5%, Goldman Sachs 4.5%. The list goes on.
Given all the headlines, war, oil, we got this new report from the Journal, Pentagon is moving additional Marines and warships to the Middle East. You would think there would be a bigger sell-off, I think, right? But broadly, really, the market has been relatively resilient. And I'm just curious what you make of that. What explains that?
Sure. I think after all these years where we've seen a lot of geopolitical turmoil, the bounce back in equity markets has been swift. Even last year when we had the tariff turmoil, it was relatively quick. Only about a month in which equity markets were really in a downdraft. And so I think investors have been conditioned a little bit to sort of buy that dip. And that's what we saw at least last week. And given the fact that this has not been resolved as quickly as everybody had hoped, I think that's why you're getting a little bit more of a sell-off this week.
You talk about, Aya, how duration of the conflict obviously makes a lot of difference. What's the difference there, like short-term shock versus a more long-term conflict in terms of domino effects on the markets? How should we be thinking about that?
Sure. I think from our standpoint and from the market standpoint, it's really that inflationary impulse that is really the concern. With higher energy prices, it impacts almost everything. And I think with yields where they are right now, we were all hoping for them to come down and help the economy overall. But if we have to stay higher for longer, that's going to be problematic, I think, for overall growth in the longer term.
Jared, another theory on why we haven't seen a bigger sell-off, let me get your take on this, is I've heard some folks argue, well, you went into this conflict with broadly the SPX it's been churning here for months. Yes. And maybe that's part of the explanation. What do you make of that?
Yes, and I think that's a legitimate point. And as I was just pointing out on the Wi-Fi Interactive, S&P 500 has finally broken down that range. So I think that is hugely significant. Arguably, the NASDAQ still in a sideways trading range, though it's at the bottom. And let me just pull up a chart of the NASDAQ here. That's the S&P 500. Here's a repeat of that, but I'm not going to go through the whole motion again. I'm going to put this to a 6-month view. Here's the NASDAQ, and you can see that is a whole lot of chop. But guess where we are right now? We're at the very bottom, threatening to break down. And I think that is key here. Let me give you the 1 year so you have a bigger picture view. This is just a tight range at the top, and it doesn't look like we're going to race toward all-time highs anymore. It could if we got a resolution tomorrow, but I think the weight of the evidence is favoring the bears right now over the bulls, broadly speaking.
You talk about how value's been outperforming. Why is that? And do you see that as sustainable, Aya?
Sure. So, value has had these short bursts. When you look at the last 15 or so years, they have these great short bursts of outperformance, but it's really been growth leading the pack for the last 15 years. I think in the short term, as we've had this AI disruption scare, the scare in software, it was a flight to hard assets. And I think that really helped that value trade in the first 3 months of this year.
Talks there about the scare in software. Jared, you've been digging into that. What do you see?
Yeah, let's pull up the Wi-Fi Interactive one more time. I've been tracking software all week long because, we're going to put that on software. This is the last 10 days. So you're going to see some green there. We had a nice rebound to the upside last week, but I was saying at the time it could be a short covering rally. I was looking at IGV in particular. That's a software ETF by iShares. It rallied into the 88 level. That was a key resistance level where I would have expected shorts, if they were in control, to re-enter the market to the downside. That's exactly what happened. So let me change this view. Here's what happened this week, and that is a much redder view. So the onus, I think, is still on the bulls to prove themselves. Software has been breaking investors' hearts for the last 6 months or so, and I think it's going to continue to do so. I was talking to Lee Munson on this program last week on the floor of the New York Stock Exchange. He's expecting at least another 10% to the downside. Things can correct in two different ways: prices and time, and it's possible they have to do both of those. But it's like Brian Shannon says, one of my favorite day traders and swing traders: if they don't scare you out, they wear you out.
What's your take on software?
Sure. So I think in the short term, it's still under pressure, and we're seeing that clearly. But I think over the long term, it's going to be about who are the winners and losers. So you have to be really selective about who you want to be invested in. I think Microsoft is going to find a way to not be disrupted.
You do. You like Microsoft.
We do. I think there's.
How much is that just because you believe in Adela and Amy Hood? The C-suite there, which is an all-star team.
It's a lot of it. I mean, management matters, whether it was, Satya and Amy at Microsoft or Jensen at Nvidia. It really does matter. And so, we do think that the overall enterprise suite that they have is just something that is going to be slow to be really disruptive across all the products that they have. You
mentioned Jensen there. In terms of war, geopolitical conflict, possible supply chain disruptions, should I be concerned about some sectors, including the chips?
Well, next week we get Nvidia's GTC, and so we'll see whether or not they've got any sort of new news there, and whether there's any update on that $500 billion line of sight in terms of revenue for Nvidia. But there are definitely issues when it comes to supply chain. The longer this geopolitical impact continues, some of those raw materials that go into semiconductor production really could be impacted. Things like helium could be an issue.
Do you see opportunities as well overseas, Aya, or do you want to stay domestic?
No, we definitely see opportunities overseas. I think, for such a long time, again, going back to that value versus growth conversation, valuations in whether it's developed international or emerging markets have been really on the, they've been stuck in the mud. I think at least from an earnings growth perspective, you're seeing better earnings growth out of both international and emerging markets, and we think that valuation will catch up.
Yeah, just to kind of hit on that point real quickly, if we go to the Wi-Fi Interactive, I'll show you what world country ETFs have been doing since the start of March, which is the last 10 days. Looks terrible, but if I show you what's happened over the last year, there's a lot of green there. I mean, in the lead is Korea, which is up 126%, then you got Peru, and a bunch of countries. The median is somewhere in 30 to 40% range. But it just goes to show you that the scare that we're dealing with right now, all the war headlines, stronger dollar, that was a pain trade. Dollar traded the upside. I'm wondering if you have any thresholds, or you're thinking like what the dollar needs to do to kind of support that thesis.
Sure. I mean, you always see the correlation between the US dollar moves and then international and emerging markets. So we do see that the strength that we've seen in the last couple of days is problematic for international and emerging markets, but we think that that's a buying opportunity. And, when you look at the dollar index over the long term, it's really been a little bit at least range bound from that like mid-90s into about 100. And so I think that's the gauge that you use to see whether or not the dollar is continuing to weaken or strengthening.
Aya, Jared, great chat. Thank you so much. Appreciate it.
Thank you.
Coming up, we check in on the health of the U.S. consumer. That is next on Market Domination. The prolonged war in Iran stirring up concerns over consumer spending taking a toll, especially for lower-income Americans. Yahoo Finance's Brooke DePalma joined here to discuss. Brooke, let's start here. Talking about this rule of thumb you mentioned, a $20 move in oil is like a $150 billion tax on consumer spending.
Yeah, that was in a Raymond James strategist note from earlier this week. And largely what we're seeing here is this oil tax. This higher gas prices is what is being referred to as an oil tax. And we've called out multiple different strategists across the course of this week who really identified that for every increase that we see in the price of crude, that's about a 25 cent, or every $10 increase we see the price of crude, that's about a 25 cent higher at the gas pump. And so ultimately, this just means that Americans are going to have to pay more. That's going to take away from their discretionary spend. And ultimately, that means bad news for potential consumer-facing companies.
We talk about the consumer, right? There's all kinds of consumers. So which is the consumer most at risk?
Well, of course, when you think about who is already struggling, who's already had a hard time to keep up and pace up with inflation over the past few years, that's the low-income consumer. And so this will sort of, increase that pressure on low-income consumers. When you think about a note that Bank of America recently came out with, it pointed that we're already seeing a widening gap. There was, for the first time in 10 years, we saw the widest level between wage growth between low-income and high-income earners. What we're seeing now in February, high-income earners' wages grew by about 4%, whereas low-incomes saw their wages grow by only 0.6%. And so think about it. We see higher gas prices. That means more that they're paying at the pump, and that means less money in their pockets. And so definitely low-income consumers will feel the brunt of this the most.
What about a potential offset from a tax refund?
Well, that was sort of the hope going into 2026, is that we were going to get larger than expected tax refunds. And that was even something that McDonald's CFO, I asked about him just a month ago. We had spoken post earnings. I said, spoken to Ian Borden, the CFO of McDonald's. I said, what are you expecting here when it comes to these tax refunds? And he said, any more money that Americans have in their pockets, that certainly would be a boost for McDonald's. And boy, have the tables turned, because now even if they do get these larger than expected tax refunds, that's immediately going back into how much more they're paying at the pump. And so ultimately we're hearing not only from Raymond James, but also from economists at Bloomberg, who say that if oil hovers around $83, that would offset all the benefits of that One Big Beautiful Bill Act.
When you're talking to executives and analysts, and maybe they're reporting earnings and on the conference calls, what are they saying in terms of their expectations of consumer behavior and spend looking ahead?
Well, something that we mentioned on the show just the other day was like Dollar General, for example. They put out this prudent outlook because they expect this uncertainty around consumer behavior. They expect ongoing pressure around consumers. And we're also hearing that from multiple other executives. Even AutoZone executives were at a city conference. And what they said was this ultimately pulls back discretionary spend for consumers. But they also said on top of that, they could even see people invest in their current car rather than buy a new car. And then JP Morgan had a really interesting note out, because what they said was that in an extreme case scenario, you could even see people kind of think, do I want to get a new car that has a combustible engine, or will I actually go back to thinking about that EV? And so this could really change consumer behavior if we maintain these higher oil prices.
Yeah, with the EV, you don't have that federal tax credit anymore either. So that's
right. That was a huge boost in September.
Are there last question? Are there companies, though, as you were doing this reporting, that there's a flip side to the coin, that the companies where they're actually maybe could benefit from all this?
Right. Well, think about what we saw in 2022 when inflation really peaked, is we saw these wholesale retailers do really well. Take in mind Costco or BJ's. Also, what we've been reporting all week is that Costco actually sells gas for about 20 cents cheaper. And so will that bring in more foot traffic? Then about 50% of those people that go to the pump, that could then go into the store that's expected. And so ultimately, will Costco get a bit of a boost in foot traffic? And similar, BJ's, maybe even Walmart's, Sam's Club as well. Also, Dollar General was even testing out gas pumps as well. So anyone that has a gas pump, if you're going there, maybe then you'll flow into the store, and that could be good news for them.
All right, Brooke, thank you. Appreciate it. Well, the U.S. economy is seeing a slowdown in growth as the conflict in the Middle East adds a new layer of pressure on consumers and markets. Joe Brusuelas, RSM chief economist, joins now to discuss. Joe, my friend, great to see you. Why don't we start here, Joe, on that kind of rush of economic data we got this morning. You were looking through it. You were writing about it, I know. Made the lower GDP read. Now, that was an interesting one, Joe, because folks, of course, were mentioning that the government shutdown there. How much, Joe, did that shutdown subtract from GDP by your math?
Oh, it's a significant dead weight overall on GDP. Look, right now there are three things driving GDP: household consumption and investment, which are holding up pretty good. And then you got very volatile trade data. And then when you throw the government shutdown on that, the government shutdown subtracted a full percent from overall GDP in my estimation. So it was a really big drag. Now, you take a step back and you look at the GDP, the durables, most importantly, income spending and the PCE price index. My takeaway is that stagflation is just screaming from the data, especially given that this was all prior to the oil and energy shock the economy is now absorbing due to the war in Iran.
Is that what, Joe, you meant when you write here to your clients? You said this is the calm before the coming storm. Explain that. What are the risks you see here, Joe, bubbling up?
All right. Well, the last couple of days, I think the big takeaway is you're going to see top line inflation move towards between 3.5 and 4% on both CPI and top line PCE. Moreover, this is just the January PCE data. And you could see core goods and core services inflation moving in the wrong way. Look, Josh, one of the unfortunate things that if you've worked in and around finance or economics for the last 30 years, wars are inflationary. They draw scarce resources away from greater productive uses. And what you're going to see now on the other side of this is, should this continue, you're going to see a draw on goods. You're going to see services rise because, hey, what's been one of the big stories over the past 24 hours? Fuel surcharges are starting to arrive. That's going to feed through transportation, trucking, and travel. It won't just be gasoline prices. This will show up at the register as you get your groceries. This will show up when you order your Uber or your taxi. And moreover, it takes a big draw on goods to build all these things that we use to fight these wars. You should expect the price of that to go up too. And this is something that just wasn't there in the forecast at the turn of the year. So the next couple of weeks can be very interesting as we all, myself included, adjust our forecast on growth, inflation, and employment. And then we're already about halfway there. We've moved our recession watch from 20% to 30% over the next 12 months. The U.S. economy is a dynamic and resilient beast. It's 30 trillion. It can absorb a big shock, but it too has its pain thresholds. And we can discuss each of them if you want as we go along.
Well, let me ask you this, Joe, though. The key question here, it seems to me, is duration of the war, duration of the conflict. I've got a geopolitical strategist coming up in the show in a little bit, very smart guy. I know he's telling clients his base case right now is 2 months, roughly 2 months. Let's use that as a base case, Joe. Let's say it's 2 months. What kind of impact on the macro would 2 months have?
Okay, if this goes on for another 2 months and just fighting and then ends sometime around the middle of May, okay, you're going to have oil prices spike, right? My first initial pain threshold is West Texas Intermediate at $125 a barrel. That translates into $4.25 at the gas pump and 4% inflation. Another 2 months, followed by an additional 60, 90 days or 90 days before the Straits of Hormuz open. Well, you're going to be talking oil at $140 a barrel minimum. And indeed, I think, Josh, your question is very well timed because back channel, Wall Street's talking about $140 to $160 a barrel under such a scenario. But we'll wait and see how that goes, because at that point, you're talking at the very least, a recession in Asia, quite possibly in Europe. And then we really want to take a hard look at just what quantity of pain in terms of an oil and energy shock the U.S. can absorb under those conditions.
Despite everything we're talking about, Joe, so war, oil, geopolitical tensions, the markets are proving relatively resilient. They're hanging in there, Joe, and I'm just curious what you make of that.
Well, it's one of the reasons to be encouraged is that 2 weeks of a pretty big stress test on the market. The market's actually performing very well outside of private credit, which has its own individual things. It's an entirely different segment. Again, look, it's a $30 trillion dynamic beast. Right now, we've got a lot of cash starting to show up in the system vis-a-vis the tax cuts. You've got Social Security, turn of the year increases in wages, turn of the year increases in minimum wage. There's a lot of good things that were happening prior to the onset of the war, and that's going to help provide the U.S. with a pretty big cushion. Now, I want to temper those comments, though. Your earlier guests and your colleagues at Yahoo Finance were talking about, well, when does the war offset the tax cuts? Okay, let me give you guys a number you can hang your hat on. For every $10 a barrel increase, that would subtract about $450 from your average household. So if you think the tax cut's going to deliver about 1,000 in extra cash, well, you get about a $25 per barrel increase. At that point, for lower end households, that's a complete offsetting case, right? Now, upper end households are getting much bigger refunds in many cases if they're incorporated businesses. They weren't paying taxes in the fourth quarter. They're probably not going to be paying in the first quarter either, due to some of the retroactive measures that are embedded inside the One Big Beautiful Act. So that just gives you a sense, though, of that cushion. It's not what we wanted. You're not going to get the growth that we thought, which was probably around 2.5%. It's probably going to be closer to 2 to 2.2% now. But nevertheless, we're not talking recession as our base case. We're just talking slower pace of growth, a higher pace of inflation, and probably an unemployment rate around 4.5 to 4.6%. Not great, but also not the end of the world. But again, we'll want to see where this goes. Wars are incredibly unpredictable. I'm not in the business talking about bombs and airplanes and tanks. We'll let others do that. But your question, again, well positioned. If this goes on for a couple months, we're going to be having a very different discussion about the U.S. and the global economy.
Finally, Joe, I want to ask you a question about the Fed, because I have some breaking news here. Get the Joe Busuelis instant analysis and take on. This is a post from Senator Tom Tillis. He says, saying here, the Trump administration's potential appeal of the Fed's Powell ruling will only delay the confirmation of Kevin Warsh as the next Fed chair. What do you make of that, Joe?
Central bank independence is a sine qua non of the modern American economy. We are better with it. And in my estimation, further encroachment by the administration on central bank independence is not in the interest of the economy, the bond market, the stock market, or the US dollar. So when I see that, I get very encouraged that, hey, the US Senate in particular, that one senator from North Carolina, Tom Tillis, intends to protect the Fed's independence. Now, what this means operationally is it's highly likely that Jay Powell is going to continue to preside over Federal Reserve meetings far past the exit date of May, which is when we were all penciling in the next meeting would be in June, and that quite possibly was when we might see a rate cut, which I think is part of the reason why the market has pushed back expectations of rate cuts to later in the year. But you know what? At this point, when I hear you deliver news like that, and I hear Tom Tillis be very consistent, we may not get a Kevin Warsh run Fed until next year, if at all.
Wow. What would be the market implications of that, Joe?
I think the market would actually like that. That means this central bank's independence would be protected. The bond market certainly will like that, and that may help on the margin, especially if the oil and energy shock shows up in a way that we don't expect, such as it begins to bleed into the core sooner rather than later. So these are all going to be intersubjective factors that are going to shape expectations and the direction of rates and inflation.
Joe, as always, it is a pleasure to have you on the show. Enjoy the weekend, my friend.
Anytime. Thank you.
Coming up, we get a look at how CEOs are considering the current geopolitical risks in markets. That's coming up next. Well, KPMG's latest 2026 CEO Outlook Pulse survey reveals that while 77% of leaders believe AI is the definitive engine of the future, 52% admit that overnight policy shifts and wartime volatility are now their greatest short-term threats. Yahoo Finance executive editor Brian Sozzi sat down with KPMG U.S. Chair and CEO Tim Walsh to talk about how executives are feeling about these recent geopolitical headwinds.
What I'm hearing from the C-suite is what we've been really dealing with over the last a year plus, right? Which is this constant pace of disruption. This is another one. It's certainly one that we're focused on in ways that we may not have had to focus on others. But if you think about it, you've had Ukraine, Venezuela, you've had Greenland, tariff with the Supreme Court, and now we've got the Middle East. What makes this one different, right, is you've got an unprecedented moment in terms of disruption in the flow of crude and the potential impact on not only the U.S. economy, but the global economy. So I know that CEOs are watching that. I know I'm watching it, certainly not even by the day, but by the hour. And we're making contingency plans as it relates to what to do with our businesses, depending on what type of shock we might see as it relates to inflation. I mean, as you think about it, whatever that number is, $10 on a barrel of crude, increased 25 cents at the pump.
All unplanned.
Right?
This wasn't on the bingo card going into the year.
Huge as it relates to consumer confidence when you drive by that gas station.
Yeah. So coming into this year, CEOs had this plan. They were going to invest this amount of money. We were going to hire these people. We were going to make these investments. Have you heard them saying, you know what, this is an economic shock. We're going to start pulling back. We're going to rein in some CapEx. Maybe we don't make that hiring or those hirings that we had planned.
Yeah, we haven't heard that yet. But early days. What I would tell you, though, is despite all the disruption that has happened over the last year plus, CEOs have not slowed their investment in AI. And that's what we've seen really come through that survey, which is this concept that investing in AI is not discretionary. It's a must-have. It's a must-do. And of course, then what comes with that is what's the return on investment? When am I going to see it? And then this need to really analyze workforce disruption.
In this environment, what are contingency plans? What do they look like when you are a CEO and leading a company of your size or other CEOs leading companies of their size?
Yeah, I mean, I can tell you certainly my own perspective and my conversations I've been having with my team this week, which is, listen, really, really strong U.S. environment. In fact, that comes through our survey as well. Like CEOs are really confident in their own businesses this year, but a little less confident in the overall economy. And so what that translates into is, okay, what are my levers? What are my near-term levers in terms of expense reduction, perhaps some CapEx, but not a reduction in AI spend, and then really managing through and understanding what the impact will be to certain markets like M&A, which has been really, really strong and consistent over the last number of months, to see what happens there.
We throw these words around a lot in financial media. Market correction, bear markets, recession. Are you dusting off a recession playbook in this environment, or you're not there yet?
Listen, we have a recession playbook, and all CEOs do, in play. The economy has gone through with tariffs over the last number of months. It was unclear what was going to happen with that. And the U.S. economy has been incredibly resilient. So yeah, we've got that playbook that's there. And I'm confident that, and my conversations with CEOs, they have been so resilient, Brian, to be able to work through these things, and they will be resilient again. The good news at this moment is that we have this technology, which is AI. If you think about tariffs, for example, to be able to model with the pace that CEOs are able to do that right now would have been unthinkable even 2 years ago, right? Millions of SKUs in terms of parts and where they're being sourced from can now be run through these modelers like our modeler with immediate views on financial implications and or how to move that supply chain. Moves to cost reduction, of course, finally, a potential increase in prices.
One of the most interesting conversations I've had, besides this one, of course, Tim, over the past weeks was with the CFO of Block. Of course, they just laid off 40% of the workforce, in large part because of AI. But what surprised me from this conversation was the speed at which AI is permeating their office, and by extension, how it's getting rid of jobs, a good number of jobs, in their case, like 4,000 people. Do you think they will be the only story like that out there?
So Brian, I cannot comment specifically on what Block did because I don't have the details on it, but let me tell you what I'm seeing out there with CEOs and with our own business. If you're in a job that is repetitive and you do the same thing day in and day out, I'd be worried right now. But if you're a white collar worker, like my professionals are, and you're working with clients, you're making judgments, you're serving your product into the company, right? You're making judgments. You're doing many things that are not just the same thing day in and day out. That disruption is not eliminating jobs within my organization. Process flows are being automated, human to agent, back to human to product. That's not eliminating full FTEs from that process. What it is doing is it's opened up the aperture and capacity, and what I'm seeing, what I'm excited about is the ability to grow our business. Overall, our workforce is not reducing. The mix of professionals most certainly is. We're still hiring the same technical expertise that we did, but we're also hiring a number of technicians. Let me give you an example. If I was delivering an engagement, this is just a hypothetical, with 20 individuals in the past, I'm probably delivering that now, maybe with 16 or 17, but I've got 4 or 5 technicians on there, technical experts, and I now have cloud compute costs on. So you need to look at the entire picture and see how this plays out. An interesting sort of viral chart that's out there right now is the Anthropic job chart.
Yeah, I think I even posted that one.
Right,
Yeah.
and you've got
how
this.
could you not?
Yeah, and you've got this theoretical discussion of what could be happening in white collar jobs versus what's actually happening. And there's a disconnect. And this concept of removing full FTEs, white collar FTEs from the process, it's not happening as fast as some might think. Again, remember, in order to put this AI in place, you've got to redo your processes, you've got to redesign, you've got to make sure your data is clean and is in the right place and the right data, and that does take some time.
Will you have the same number of employees like 5 years from now at KPMG?
I'm optimistic that we'll have more. Why? Because my business will be bigger.
Are you still using software internally? I look at these software stocks, and they've been hammered under the view that big companies, maybe like yours, are not going to be using some of their services anymore because you have an agent running, 15, 20, 10,000 different tasks. Are you using this stuff like you were?
We are absolutely using the software products as we were. And listen, Brian, I don't have my head in the sand. I'm watching this every single day, and I'm watching the patterns that go around it. But I'm confident that our alliance partners and those that we work with, those that provide value to us every single day, they're optimizing their business models as well, embedding AI, and I'm confident, I'm hopeful that they'll be super relevant in the future. Of course, there's going to be disruption. Tech is always about disruption. Sure. And so it's going to make all of our products better, though, Brian, that I have no doubt about that.
Lastly, on going back to geopolitical issues, do you think that slows up the amount of deal activity this year? Because the thinking was this was going to be a good year for deal activity. We're still waiting for some potentially big, large IPOs, and I'm starting to get worried if those even happen.
Yeah, the IPOs have already slowed in terms of, there's a big pipeline that's on the sidelines waiting to happen, and those have slowed recently in terms of what's come to market. On the M&A front, what I would say there is we need to watch, right? There are going to be industries that may accelerate around aerospace and defense, et cetera. And then I'm sure there'll be a lot of diligence being done right now as it relates to price volatility, depending on what happens with inflation. However, this disruption is not something new, as I mentioned. And so the capital has been on the sidelines for a while. We've seen that come in because CEOs they've got to make business decisions. They've got to move forward. They can't just pause. And so I'm optimistic that the M&A trends and activity will continue.
Good to see you, Tim. Enjoy the rest of your weekend. We'll talk to you soon.
Great to be here.
Appreciate it.
Coming up, we get an analyst take on Disney's incoming CEO. That's next. Disney is about to get a new leader. Josh D'Amaro takes over as CEO next week with a host of challenges waiting at his desk. Let's get into what's in store. Jason Bazinet, Citi's media and entertainment senior analyst, joins us now. Jason, always great to see you. So Disney has a new CEO, Josh D'Amaro. Maybe just start there, Jason. What do you make of Mr. D'Amaro? Was he the right man for the job, given his resume, experience, background? Did you like that pick, Jason?
Well, we did. I mean, Disney, as you know, or your viewers know, has had more difficulty than you might imagine in terms of succession planning. And so I think having someone come inside the company that isn't a big surprise is a big plus. I would say the vast majority of investors were a little bit fearful of co-CEOs that we've seen at some of the other companies. Wall Street generally doesn't like that, so they dodged that bullet. And then among the two leading candidates towards the end of the race, Dana Walden was generally not preferred. So I would say, yes, this is a good outcome for those reasons.
One knock, Jason, you know this was, you heard when this was announced, D'Amaro, he's a leader, but he's an operator. He doesn't have the creative chops. What did you make of that?
Well, I hate to say this. I mean, they said the same thing about Bob Chapek. And of course, he didn't last too long. But I chalk that more up to COVID, not a major risk. I mean, in fairness, Disney hasn't been firing on all cylinders on the creative side for some time. I mean, just in the last year, we had the Snow White flop, Thunderbolts flopped, Tron flopped. So, Disney isn't firing on all cylinders. And so, when I used to work in a real job, they used to say a manager's best friend is a bad base year. So this may set the new CEO up for better days ahead.
What, Jason, do you think his priority should be?
Well, one thing that I would say that I know works on Wall Street is you always get a higher multiple if you don't have strategic hedges embedded in the company. And I would say today, Disney does have a strategic hedge embedded in the company. And what I mean by that is, yes, they're leaning into streaming with Disney Plus, but they also have a foot in the legacy business with TV stations that cover about 25% of the US population. I think it would be a much cleaner story if they just went all in on streaming and sort of unwound that strategic hedge. I would say that the second main priority is almost every metric we look at, there is definitely an appetite for creator-driven content, shorter form content. And, Disney's dabbled around the edges in this with a strategic investment in Epic Games and investment in OpenAI. But I'm not sure there's like a crisp strategy for how they're really going to use AI and consumers' appetite for short form content to really lean into that. That would be number two. And then number three, and I used to have this discussion with Mr. Iger, I think the problem with the streaming apps that Disney has right now is they've got the great iconic intellectual property that caused people to come to the app, but we've long argued there's not enough tonnage of, for lack of a better word, for undifferentiated content, plain vanilla content, to keep you in the app, and that causes a lot of churn. And so I'd like to see them spend more money on really unspecial content, and I know that sounds disparaging, but I think that's what they need if they're really going to position Disney Plus as a pay TV substitute as opposed to a niche streaming app.
And when you told Mr. Iger all this, Jason, what was Mr. Iger's response? How did he react?
Well, he just raised his eyebrows. I mean, remember Mr. Iger, the way I describe what made him a great CEO is he went out and bought Marvel and Pixar and Lucas and very carefully made iconic movies that then ported themselves into the park, right? And so it was the classic Disney flywheel. So what I was really asking Mr. Iger to do is take all of the things that made you a great CEO that transformed Disney and throw them away. And so I don't think it ever really resonated with him or sat with him. Making undifferentiated content just isn't how he thinks about Disney, and it's not what made Mr. Iger a great CEO. What I was arguing is, that's great. It did work well at that period of Disney's history, but we need something different now.
I'm just curious what you see ahead for Josh D'Amaro's bread and butter, the parks business, Jason. What do you forecast just in terms of attendance, pricing, profitability? What does it look like?
Yeah, I would say it's I would say low. Well, let me give you context. Disney went through this phenomenal period when you took that iconic IP from Marvel, Pixar, and Lucas, and you put new rides in the parks where they were able to both raise pricing and grow attendance. And that's like a powerful elixir, right? If you can get both pricing and volume up. I think they've got about 3 or 4 more years where they can raise price without having demand destruction. And then from there, I think it's going to be more challenging. And I think that's why Disney's embarked on this big CapEx initiative to try and give them another lever. So what do we have in our model? I'd say 4 to 5% top line growth. It's very little attendance growth, 1 or 2%, a little bit of pricing. And you can have both of those moving up for probably 3 years, and then it's going to get more difficult.
Jason, I'll end here. You got to buy on this name. The stock, of course, listen, it's well in the red this year. It's basically flat over the last 12 months. What are the catalysts, Jason, near to intermediate term that you think that could get investors excited about this name again?
Well, it's really interesting. I mean, we've covered Disney for a long time, and for my entire career, Disney always traded at a premium to the S&P 500. On my numbers, it's 13 times next year's earnings. So what does that tell me? I mean, does Disney really deserve a 13 PE multiple? No. What the street is terrified about is that they're gonna have to lower their guidance this year. That's why the multiple is at 13. And there's 2 elements to that. One of them is people are terrified of this NFL renewal that they're going through, that's going to blow a hole in their guidance and cause them to lower it. And the second thing is that you have to painstakingly go through what all the hedge funds do and money managers, your EBIT bridge, and look at it by quarter. And when you do that, you discover that it is naturally a very back-end loaded quarter. So the street was disappointed at fiscal Q1. They were underwhelmed with the guidance. The company's maintaining their full year guidance. They have 2 more quarters to go, and the street just doesn't think they're going to be able to deliver that full year number. I would take the over on that and say they will not lower guidance. They're going to hit it.
Finally, just I'm just curious. As you know the name so well. You've covered it for a long time. What would you ultimately make of Iger's tenure here? What grade would Professor Jason give him?
Well, I used to joke when Mr. Iger was a young CEO, when he just started out, I was not bullish on Disney, and I would get a huge amount of pushback from portfolio managers, and they would say, "Why do you not like Disney? Disney's just a well-run media conglomerate." And I would say, no. Disney is ESPN masquerading as a well-run media conglomerate. Because when we looked at the returns on invested capital and everything other than the cable networks division, I'm talking parks, studio, consumer products, they were barely earning their cost of capital. What made Mr. Iger great is he actually improved all of those other businesses and where they were earning their cost of capital, exceeding their cost of capital. So he fixed sort of the core of Disney. What then happened beginning in 2017 is the cable network, the linear business began to fall apart. And that's when things sort of went sideways. And that's where I would give him lower marks because exactly what I said earlier, he never positioned Disney Plus to become a pay TV substitute. He sort of went in halfway and then stopped investing. And so I would give him sort of an A+, I would call it, in the first part of his tenure, and a B- in the second part of his tenure.
Jason, as always, such a pleasure to have you on the show. Thank you.
Absolutely. Thank you.
Earlier this week, Yahoo Finance tech editor Dan Howley got his hands on all of Apple's new products. Take a listen.
People have been asking for it for years, and Apple has finally done it. They have a MacBook for everyone. This is their newest, the MacBook Neo, and it's $599, powered by Apple's A18 Pro processor. That might sound familiar if you've been following Apple for a while because it's the same chip that's found in the iPhone 16 Pro and Pro Max. That's right, this is running on an iPhone chip. It also has 256 gigabytes of storage. You can upgrade that for an extra $100. You would also, if you did that upgrade, get a Touch ID sensor on here. This is a great option. We have on the side, purposefully, a headphone jack. Apple said that they did that because this is meant for classroom use as well. And so a lot of schools use wired headphone jacks because, I mean, let's face it, they're less expensive than a pair of AirPods. There's also 2 USB-C ports on the side. One allows you to output to another display so that you can, view more content, things like that. Overall, I mean, for $599, you're getting an incredibly well-built device. Usually in this price range, anything is going to feel relatively chintzy, kind of cheap. This, not so much. It feels great. They didn't just launch that though. They also have a new MacBook Air. This is $1099, and it's generally the same kind of layout that we saw in the prior MacBook Air. This is the 15-inch, but this time it's running Apple's M5 processor. That's its most recent in-house chip. It comes with 512 gigabytes of storage. That's an upgrade, which is kind of how you can zhuzh it to say that it's really not a price increase from the $999 last year. Overall, it's still the same great MacBook Air that you would expect. You have the ports over here, obviously, as well as a MagSafe charger. Over here, you have Touch ID as well for logging in. Great keyboard, great touchpad, and up to about 18 hours of battery life, Apple is saying. So it's going to get you through the day, no problem. This now is the big daddy of the group, a new MacBook Pro. This starts at $1699. This is the high-end computer that you would be using for AAA games or for developing. It's now running the M5 Pro and M5 Max processors. Really, if you're going to get this system, you already know that you need a lot of horsepower, and you've been eyeing this probably for some time. Similar design to last year's version of the Pro. Basically, it's all upgraded internally. So you're not going to notice too much from the outside. Overall, if you need a computer that really has the oomph necessary to do things like compiling lots of code or doing a lot of heavy video editing, this is going to be the computer you get. Oh yeah, and don't forget, they also launched the new iPhone 17e. This starts at $599, similar price to the Mac Neo. And the big thing about this is that it's meant to be an affordable entry into the iPhone ecosystem. Now, it's $599, that's $200 less than the standard iPhone 17. You do give up a few different things with that price change, though. You only get one camera around the back rather than two that you would find on the iPhone 17. Up front, you also don't have that dynamic island that you get. Overall, this is a very good device, but those trade-offs are going to be a serious consideration for a lot of people, especially when it's only a $200 price difference. What it really comes down to is what you want out of your phone. If you don't really care too much about having two cameras and you don't really care about the dynamic island, then there's no reason to not get the 17e. But if those are things that you really do want, then I would go ahead and upgrade with the 17.
You can use that. Thank you very much. Just move away.
Stocks ending the day and the week lower. Our very own Jared Blickery is standing by with the latest headlines. Jared.
Yes, Josh, not only lower, but closing again close to the lows of the day. Here's the Dow Jones Industrial. Key here, we started in the green, drifted lower all day, then accelerated into the red, into the close. That is not the best sign here. And for the 5-day price action, we are seeing a drop of about 2% there. Here's the NASDAQ down just under 1% today, 1.26% on the week. You can see we were looking pretty green around Tuesday. That has faded. And then finally, here's the S&P 500. That is down 1.6%, pretty similar chart there. As I pointed out an hour ago, we have gone from kind of climbing into the end of the day to selling into the end of the day, and that's not what you want to see here. I was also taking a look at the VIX, and let me put a year-to-date chart there because we are once again in the high 20s, not the peak. We saw that earlier in the week, late last week, but we are pretty close to there, and it just looks like there's a lot of uncertainty baked into the market right now. This is measuring options in the S&P 500 30 days out. So this is not the retail crowd. This is institutional money showing that uncertainty. And in large cap sector land, we had a pretty defensive day of the sectors that were in the green. Utilities leading, that's defensive. So is staples, so is energy, so is real estate. Financials, not so much, but healthcare as well, even though that was down. Materials, the biggest loser there. And then tech and communication services rounds out the bottom three that were underperforming the S&P 500. And if you take a look at the 5-day, only energy and utilities in the green and some fairly substantial losses for financials, consumer discretionary, and industrials there. So another down week. That's going to be 3 for the major indices in a row. Let's check out the NASDAQ 100 today, and you can see a lot of red in those mega cap names. Broadcom down 4%, Meta almost 4%. We do see some green, especially in some of the names. Let me just split it down by industry. Here's software. Some of the smaller names green, like Zscaler, that's up 1%. HubSpot up 2.5%. DocuSign up 1%. But as the bigger names, a lot of red there. Semiconductors, besides Nvidia and Broadcom, a little bit more strength today. Micron up 5%, SanDisk up almost 7%, and Western Digital up about 4%. And then I will close with the Dow. Aside from the mega caps, you take a look at the right-hand side there, we are seeing some green. Walmart up 1%, United Health up almost 2%, Verizon up 1.5%, Boeing up 2.5%. Aside from Boeing and maybe 3M, a lot of those are defensive names, so not the best quality leadership in terms of those green stocks that I was just ticking off. So not the greatest ending to the week here, Josh.
All right, thank you, Jared. Appreciate it. Let's look at the energy markets now. Oil prices have surged above $100 a barrel for the second time since the war began, as the conflict sees no signs of ending. Inez Frey joining me now for more. Inez.
Yeah, Josh, and if we take a look at the energy markets right now, I mean, WTI up more than 8% for the week. You've got Brent crude up around 11% for the week. Brent going back above $100 per barrel. And the bottom line is that despite the all of the things that have been done to sort of try and calm the energy markets, you are still ending up with oil above 100 a barrel when it comes to Brent. So you've had SPR releases, you've had easing of some sanctions as well. You have considerations perhaps of doing away with the Jones Act temporarily because of these price hikes. And you are seeing, though, that the energy market is still not calm. And that is because the Strait of Hormuz is still nearly at a standstill. We took a look at data from Lloyd's List Intelligence. This is a firm that tracks the maritime traffic. And basically what they've shown is that between March 1st and March 10th, only 77 transits went through the Strait of Hormuz. Typically, during that period last year, you had over 1,200 transits. So you can see the minimal traffic that has gone through. And some of that traffic are Iranian-tied vessels. So you are seeing that Iran is able to take some of their oil, to be exporting still some of their oil, but not the case for the rest of the vessels that would like to go through that strait. So certainly the uncertainty of the Strait of Hormuz is really what has been driving these markets higher. And by the way, even if the U.S. Navy is able to escort out vessels at some point, this data is showing that that would only account for less than 10% of the traffic through the Strait of Hormuz. So this is not a solution yet to the big problem with respect to the war.
All right, Nez, thank you. Appreciate it.
Thank you.
Meanwhile, U.S. Defense Secretary Pete Hegseth says he's determined to keep the Strait of Hormuz open despite Iran's supreme leader vowing to keep the maritime passage shut. Dan Alamariu, Alpine Macro's chief geopolitical strategist, joining me now. Dan, it is great to see you. So let's start here, Dan. Investors listening right now, they're very focused on the timeline, Dan, when we think this war could end. I know your base case, you're telling your clients roughly 2 months, you say. What are the signs and signals you're using, Dan, that would kind of suggest to you, okay, this war is coming to an end soon, or no, maybe it's dragging on longer than expected?
Hi, Josh. Good to see you. So, indeed, we think about roughly 2 months is the duration of the conflict there. Of course, everybody's focused just on that question. Ultimately, both sides face a self-limiting dynamic. Where prolonging the war threatens their own political survival. And yes, that even includes Iran, although the regime appears to be quite resilient. I'd say that there are 3 signs I'm looking at in terms of how this goes. First of all is escalation signals. Iran, for example, could escalate by closing, using the Houthis to close the Red Sea to shipping. You could think of other things like terror attacks in the West. On the U.S.-Israeli side, attacks on strategic points like Karg Island, Iran's main oil terminal, which handles 90% of its crude exports. Another sign would be anything to see where we can observe regime continuity and stability in Iran. There are signs that maybe the military elites are cracking, although that's anecdotal. Are there challenges to the regime? Sometimes you can't see this in advance, but the longer the war goes, the more vulnerable the regime becomes to sort of challenges from within inside the regime. Lastly, talk of negotiations that, though often, if we see those would be headline risk and attempts by the White House to try to use the bully pulpit to stabilize markets, as we saw Monday.
Dan, what about this headline we did get today? Curious to get your take. The Journal is reporting that the Pentagon is moving additional Marines and warships to the Middle East. What did you make of that headline, that news, Dan?
This is not, I mean, it's interesting. It signals potential, I would say, incursions within Iran and sort of attempts to hold strategic strong points. It doesn't signify sort of a mass invasion as in, let's say, Iraq in 2003. The way to think about it is the United States, if the war continues and if the Straits of Hormuz stay closed, the United States may try to attempt to take over the Karg Island, the main Iranian terminal, or strong points along the Straits of Hormuz to help reopen the straits to shipping, which would put a lot of pressure on Iran. If you take Iran's oil revenues, at that point, basically the regime has a significant problem in terms of paying its military apparatus.
Dan, you told clients if the Strait of Hormuz does remain closed for months, oil could move above 100, maybe even toward 150. How realistic is that scenario, Dan?
Pretty realistic. Look at what happened Monday. Brent oil hit about, I think, $119 intraday. That was on March 9th. Again, if it stays closed for, let's say, the duration for 2 months and the U.S. cannot open it, which seems to be the base case, oil over 100 is already here, and 150 it could be easily reached, especially if Iran continues to escalate, especially if you have a closure of the Red Sea by Iranians' proxies in Yemen, the Houthis.
Maximum market panic, Dan, you say likely coming in the next 1 to 3 weeks. Explain that timeline for us.
Well, when you look at the similar wars and you look at human psychology and investor psychology, basically the first week of the war, nothing really happened in markets. And now, again, we see the war being priced in this week. If you extend this out a week or two, markets will start to price increasingly an open-ended conflict. They're going to think that this war will last not 2 months, which is already long and could have a negative effect in the economy, feed into inflation, into lower growth. But they're going to price something much longer than that, which, again, it is plausible. If that happens, at that point, I mean, it's very plausible to see a deeper market sell-off, a market correction even in the United States. And again, historically, if you look at this, if you look at Russia, Ukraine in 2022, at the first Gulf War in 1990-91, peak oil prices, which are a good proxy for peak panic, usually happen somewhere in the conflict between weeks 4 and 8. We're approaching week 4.
How this all ends, Dan, you write, informal ceasefire where both sides claim victory. Why, Dan, is that your base case?
The base case is because if you look at it, it seems that the United States hasn't fully thought out how this conflict would go. It doesn't seem prepared for a long-term war. Again, there's not a lot of domestic political support for a prolonged conflict in the Persian Gulf. I think at some point, if neither side can deliver a knockout blow, and if U.S. and Israel fail to fracture the regime, Iran clearly cannot defeat the U.S. militarily, but it can impose significant economic costs. They both have an incentive to settle in order to preserve regime stability in Iran. They are getting degraded. I mean, the longer the war goes, the more the regime faces a risk of fracture. United States obviously has midterms. So I think what could most likely happen is the United States declares its objectives achieved, stops fighting. Iran follows shortly after. There's no formal ceasefire, and both sides claim victory. This is essentially how the 12-day war last year ended. I mean, Iran right now is making outside demands. I wouldn't reach too much into those to be met. So I think, again, the practical outcome is a mutual stand down. There are, of course, other options. Iran could give in, could agree to negotiations. And again, there's still a possibility that the Iranian regime actually cracks, that you have some sort of regime failure. How that plays out, of course, is entirely uncertain.
Finally, Dan, I'm a viewer, I'm watching this right now. I'm trying to gauge where this war is headed. There's so many headlines, of course, it can feel overwhelming. What are just the 2 or 3 signals, Dan, you use, maybe military, political, economic, that you would rely on to give you a clean line of sight?
Great question. So from a military perspective, again, the sort of the strike tempo in Iran, from Iran's perspective, the declining launches of ballistic missiles and their capabilities being exhausted, whether the actual leaders of the regime survive, and that can maybe indicate if the war is winding down. Escalation, as I said, from the Iranian side in the Red Sea or elsewhere, again, does the U.S. move to try to pry the Straits of Hormuz open? Those are other things I would watch. Economic, again, the Hormuz shipping traffic, any kind of market shocks or again, the conflict lasting and starting to feed through the economy, causing inflation or stagflation, those would be things to watch. Again, that would increase pressure, of course, on the U.S. And political, again, anything resembling negotiations, off-ramping from both sides, those would be some of the things I would watch. And again, there's a strong possibility before we get to any kind of settlement or the sort of mutual stand down that I think it's most likely that we see escalation, sort of from both sides, this kind of escalate to de-escalate or reach a deal.
Dan, we're always lucky to have you on the show. Thank you, my friend.
Thank you very much.
Stick around. Much more Market Domination Overtime. That's coming up next. Oil prices remain elevated as we close out the second week of the conflict in Iran. Julie Hyman spoke to Laffer Tengler Investment CEO Nancy Tengler about where the opportunities may be for investors in the energy sector.
I am curious about energy. I mean, already these stocks have had so much upside. Do you think that there is more room for upside? I mean, what the sort of indications we're getting from them is with prices up, they're not that much more likely to pump more, to produce more than they are right now. But, could benefit in other ways, margins, for example. So, I mean, do you think that now is a good entry point for those stocks if people aren't in them already?
I mean, I would be more inclined to be trimming them. And that's because we think, there are other alternative sources of energy. We have a thematic portfolio that has one of the themes is nuclear. I think that will be a competitor. EVs are not dead. So I think you want to be careful to chase this because these are cyclical companies that when you go back and look over the last 15 years, and let's just use the integrated oils as an example, they have underperformed in general. And that's with multiple periods of price spikes in the price of oil. So I wouldn't be chasing it. I'd be focused on other areas that have been hit and really use oil maybe as your source of cash or energy stocks.
Gotcha. Okay, so let's talk about some areas that have been hit. I know that you've been adding to the likes of Microsoft, which is on that list of stocks that's been hit, Palantir, which has come back a little bit but is still down from its highs. And of course, there is still this big debate ongoing about which software stocks are going to be disrupted. I don't often hear Microsoft on that list, but of course it has sold off with the rest of software.
Yeah. Well, and we added to ServiceNow, which is a harder one to swallow because it's been popping around, though it did have a nice move up. Here's the way I see it. I think I've talked to you about Adobe. We exited the stock about a year and a half ago. It might have been a little bit longer. And one of the things that stuck out to me is that you had a stock that had underperformed the S&P, not just underperformed, but had a negative cumulative return of about 30% over the last 5 years. But you had a CEO who many celebrate, and I think he did a lot of things right in the previous 10 years, but he got paid $220 million during that period. And the company missed the pivot. Think Intel, think Xerox. And so I think that is the kind of company you want to stay away from. I would not buy the dip. That's not to say it won't get a dead cat bounce rally at some point. But I think names like that, CRM, Salesforce, are names we've shifted away from and focused on the integrated players, the ones that we think are going to succeed over the long term and even see margin expansion, as well as the cybersecurity names. We also added to CrowdStrike during the sell-off.
Oh, interesting. And you've been a Broadcom fan from way back, Nancy, on the supplier side, right? The companies that are sort of infrastructure for AI here. It has been pretty interesting within even those sort of AI leverage plays that do well. The numbers look good. We haven't always seen the stocks perform. And what do you think is going to need to change in the market sort of mentality that maybe means that companies will get rewarded a little more consistently?
I think they just need to keep putting up earnings. I mean, in the case of Broadcom, it has dramatically outperformed if you look over a 3 to 5 year period. Same with Nvidia. I would even argue AMD. We own all three. But I think what you need to see is investors return to fundamentals. And if you go back and look over the last few years, we've sort of seen the Russell 1000 value stocks. So think consumer staples, some electric utilities. We've seen those surge in the first quarter, first half of the year, and then we've seen the market return to growthier and in some cases you could argue defensive technology names. I mean, that's why we own Apple. Well, there's a lot of reasons why we own it, but it is sort of the treasury bill of our tech holdings, and we added to that a number of weeks back as well. So I think that's what investors need to think about, is looking forward and not buying into the short-term narrative. You and I talk about it, and it's important, but they shouldn't be investing their portfolios accordingly.
Nancy, of course, another one that you mentioned that you've liked is Nvidia. And this is a fun one. My team was looking at Polymarket and found that there is a poly market bet you can make on how many times Jensen will say various words in his GTC keynote next week. That he'll say AI or artificial intelligence, what is this? More than 10 times, that's the biggest bet, or it's matched with GPU more than 5 times. I mean, these are easy bets. Come on, people. Million, billion, more than 3 times. Agent or agentic and autonomous. I don't know. This seems like kind of easy money to me. It doesn't seem like much fun to bet on something that is probably definitely going to happen. But Nancy, what are you looking for from those comments?
They should be measuring whether or not he's going to wear a black leather jacket.
I mean, that's also an easy bet, no?
That's right. I think, well, we're looking for a couple of things. You know, in the old days, Julie, we used to watch Larry Ellison when he came on stage for Oracle, and we all had bets in the audience with BlackBerries, if you can believe that, how long it would take for him to slam Bill Gates. And I think the record was like 15 seconds.
That's amazing.
But I think, you know, we're looking at a couple of things. This has tended to be more of a narrative event than a change in sentiment event, though there have been exceptions. We're looking for, you know, an updated 3 to 4 year roadmap around Vera CP, which is CPUs, Rubin, which is GPUs, and then Rubin Ultra. I mean, this company has already guided $500 billion in fiscal year 27, which is right now and ends in January of 27, in just those chips alone. And that's just, I mean, that's almost unheard of. And so we want to see if there's any difference. We heard today that ByteDance is going to have access to Blackwell to the tune of about $2.5 billion. That's not in the numbers. And then I think the one thing that's being overlooked is Sovereign. And it tripled year over year in last quarter's earnings report. So I want to hear Jensen talk a little bit about that and where they see the opportunities. That's not on your poly market list, Sovereign. So we'll see if
No, Sovereign should definitely be on that list.
Coming up, we look ahead to the Academy Awards. Don't go anywhere. Hello and welcome to Asking for a Trend. Hollywood's biggest night, the Oscars, are this Sunday. Actors, directors, writers, and more will be celebrated for their achievements in film. This comes as the media landscape continues to change, with Paramount now potentially acquiring Warner Brothers Discovery and more consumers choosing to stream movies from their couches instead of heading to the theater. Joining me now on this is Paul DeGarabedian, ComScore Senior Media Analyst. Paul, it is good to see you. So let's start about talking about this box office, Paul, and what you see there, which does look like it's showing some momentum. You say estimated 96 million this weekend. That's up strongly year over year. 2026 revenue, you say, is running about 13% ahead of last year. What is driving that, Paul?
Well, it's really been an interesting first quarter. It's been sort of a 2 steps forward, 1 step back, but we are running 13% ahead of last year. And certainly Scream 7 overperforming definitely helped the box office. And in addition to that, you've still got some of the movies that are nominated for Best Picture in theaters, but they've really, they've wound down their theatrical runs. But it's interesting to see what the Oscar nominations bump does for a movie. Hamnet jumped about 35%, or it's added 35% of its box office in the post-nominations period. Nominations announced back on January 22nd. Marty Supreme up about 15%. Earnings post-nominations. And The Secret Agent, Sentimental Value. Some of those films have really seen a big bump in their box office. That's contributing, but also a family movie like Goat, the latest Pixar movie, Hoppers, have done very well. But it's been a bit of a challenging first quarter. But Q2 is going to be huge with Super Mario Galaxy that's opening in April. But let's not forget Project Hail Mary coming out in about a week, and that's going to be a big mover as well.
One trend you pointed out, Paul, which I thought was interesting, Gen Z kind of leaning into the theater experience, actually. They now account, by your math, we got they now account for about 39% of the audience. That's up from 34% in 2019. What do you make of that trend, Paul?
Well, Josh, you've done your homework. That's exactly right. Our box office data and our post-track audience data shows that. Cinema United as well. They're the big trade organization for movie theaters, really in on that kind of data, being a big part of figuring out who the audience is. And that younger audience, that's an audience that we thought was lost to the small screen years ago. But what's happened is you've got the digital natives, people born in that Gen Z category, embracing the analog experience of going to the movie theater and using the movies as a hub of influence, a way to create that FOMO factor with their friends. So it's really cool to see that younger people are embracing vinyl albums. Of course, that's a big mover as well. So I love that these analog experiences, like going to the movies, playing vinyl albums, that kind of thing, the tactile, immersive experiences are really resonating with the younger generation. That's great to see. Next thing you know, we'll be looking at analog watches again. It'll be pretty cool.
Paul, streaming, Paul, was once thought of as this potential real existential threat to theaters. Have the two learned to coexist?
Yeah, I think so. When you're seeing like Netflix releasing films in theaters, obviously Amazon MGM putting movies in theaters, and then just recently, I believe yesterday, the day before, Universal announcing an at least 5-week window for movies to be in theaters. That's a commitment to the movie theater, not shrinking that theatrical window. That's very important. And no matter the ups and downs of the box office, you're always going to see that. If you take a sliver of time when the box office might be down and then make a big pronouncement that, streaming has killed the movie theater, then a week later or 2 weeks later, you could have a big movie opening with over 100 million. Suddenly the movie theater experience is doing great. And I think overall you have to look at the long tail of that long-term impact. This year we'll be at around 9.3 to 9.5 billion. Next year, 2027, could be an even bigger year at the domestic box office. Who knows, maybe we get to 10 billion worldwide. Last year was over 32 billion, according to our ComScore data, and just over 9 billion domestically last year. So we're in really good shape. Again, there's challenges. And to answer your question, streaming can be additive and complementary, not adversarial with the movie theater. It just means there's a lot of competition out there, and that movie theaters at their local level, in theater marketing, local outreach to potential patrons is really strong, and pricing matters as well. But it seems like people love going to the movies. They just need a really good reason to go, because there's a lot of great content at home on your small screen, but there's nothing like going out to the movie theater.
Paul, the Oscars are on deck.
Yeah.
Polymarket, we should know. We should mention this, has odds that one battle after another, Paul, that Polymarket says, that's going to win Best Picture. What do you think? Would that be your bet, Paul?
I'm a big Sinners fan. I absolutely love that movie. And those are the two, top contenders. I think the momentum has been with one battle, but after the actor awards, where Sinners won the ensemble award, kind of shifted. But if Paul Thomas Anderson, let's say because of his body of work, from Boogie Nights, There Will Be Blood, and now One Battle After Another, if he's the odds-on favorite to win Best Director, movies don't direct themselves. So I think that the odds-on favorite might be, or should be, or could be One Battle After Another because of Paul Thomas Anderson. But Ryan Coogler, absolutely amazing job with Sinners. Who knows? I've seen so many awards, Academy Awards, where I'm like caught off guard. And so anything can happen. That's why we're talking about them. Polymarket, I think it's really interesting because they're putting odds on everything. Sound, costume design, every category is up for speculation in terms of who has the best bet in terms of winning at the Oscars. No matter what, just to be nominated is a win, as they say. So I have to look at it that way.
Paul, Oscars moving to YouTube in 2029,
Oh, yeah.
I think, right? What did you make of that news?
I think it's interesting. I think it's just showing how entertainment is evolving, the platforms. Netflix at once upon a time was the folks who sent you a DVD in the mail and you had to return it. Now look at them. YouTube has been, I think, underestimated for a long time, marginalized in some ways. It's like the Rodney Dangerfield of platforms, even though it's the biggest streaming platform, if you will, in many metrics. So I think that's kind of cool. It's combining new school, old school. And it's not like the Oscars are going away. They're here to stay. But remember, movies have to play in a movie theater to get nominated for Oscar. And that's going to continue. But again, small screen, big screen synergies. See the movies in theaters on that huge screen. Watch the Oscars on your small screen, whether it's on ABC or when it shifts to YouTube. People are going to be interested in that.
Paul, as always, great to have you on the show. Thank you.
Thank you, Josh.
And you can scan the QR code on your screen to go to the Yahoo Finance Prediction Markets Hub, powered by Polymarket. Stick around. Much more As for Trends still to come. A federal judge handing the Fed a win, blocking the Justice Department subpoenas issued to the Federal Reserve Board. But the Trump administration not backing down without a fight.
No one, folks, is above the law. And this outrageous decision will be appealed by the United States Department of Justice.
Yahoo Finance's Jennifer Schonberger joining us now with the very latest. So, Jen, big picture, what did the judge exactly rule here, and why is it such a big win for the Fed?
Yeah, this is a big win for the Fed because that federal judge essentially invalidated the Justice Department's investigation into Chair Powell and the central bank. U.S. District Judge James Boasberg basically ruled that those subpoenas were improper. He wrote in a 27-page opinion that was unsealed today that, quote, there is abundant evidence that the subpoena's main dominant purpose is to harass and pressure Powell to either yield to the president or to resign to allow the president to put in place somebody he would be able to essentially push around. So the judge really getting at the core of what Chair Powell had criticized about this investigation, that it was an assault on the central bank's independence. And it was really a policy difference, not what Chair Powell had said on Capitol Hill last summer when he testified before the Senate Banking Committee on the amount of renovations to the Federal Reserve's headquarters here in Washington. And of course, this is going to have major implications for the nomination process for the next chair of Kevin Warsh, because Senator Tom Tillis, who sits on the Senate Banking Committee, has vowed to block any nominations confirmation as long as this investigation remains unresolved. Today, seemingly, we had a resolution, but now U.S. Attorney Justice Jeanine Pirro saying she's going to appeal this. And Tillis out with a statement already on X saying that, quote, appealing this ruling will only delay the confirmation of Kevin Warsh as the next Fed chair.
Can I ask you, Jen, how unusual is it really for the Justice Department to subpoena the Fed like this to begin with?
It's unheard of, Josh. And the time since the Federal Reserve was erected, we have never seen this in the history of the central bank. Justice Pirro said that the U.S. judge had neutered, using her words, the grand jury's ability to investigate this situation. She said that she reached out numerous times to the Fed. She was able to share 3 specific dates, including the first week in January, in which she said she reached out to the central bank and got no response, and therefore had no choice but to launch this investigation. So sort of casting it as information gathering. But she and this administration, she's a close confidant, obviously, of President Trump, seemingly not backing down at this point.
I talked to Joe Bruce-Wallace earlier in the show, Jen, and this was sort of breaking as we were discussing. So I read this to Joe, just get his instant analysis. And Bruce-Wallace was saying we might not get Kevin Warsh as Fed head approved this year, or if at all, Joe told me. And the markets, he said, Joe told me, Jen, he said the markets would like that. And I'm just curious to get your response to that.
I'm not sure I agree with that. I think that we will see an end at some point to this investigation. I think that Secretary Bessent, other members, Republicans in Congress will find a way. It will probably be down to the wire to get the Warsh nomination hearing done and confirmed in time for that May 15th deadline. I don't know how, but they're probably going to try to find some sort of off-ramp or some way to do this. I think it will be down to the wire. Worst case scenario, I think maybe Powell is held on as chair for a little bit longer, but I don't think that we're going to go the whole year without seeing a new Fed chair. I just don't see that happening.
All right, Jen, thank you so much. Appreciate it. Time now to watch the week of March 16th. First up, Nvidia will be kicking off its biggest event of the year. The company's GTC AI conference will include a keynote from CEO Jensen Huang on Monday. Huang will provide developers, analysts, and the press with updates on what Nvidia is preparing for in the year ahead. Yahoo Finance will be on the ground in San Jose to bring you all of the latest highlights, so be on the lookout for all of our coverage of that conference. On the earnings front, investors can expect to get more color on the consumer. Dollar Tree will be first up in reporting its quarterly results, followed by Lululemon on Tuesday, ending with Macy's and Five Below on Wednesday. The results will provide a read into the struggling consumer. Sentiment, we know, has seen a decline in March, reaching its lowest reading of the year. Consumers feeling the immediate impact of higher gasoline prices amid the conflict in the Middle East. Gains for oil, along with inflation worries, have shifted expectations around Federal Reserve policy. Wall Street widely expecting on Wednesday for Fed Chair Jerome Powell to announce no change to interest rates. Investors have been scaling back bets on rate cuts this year as the central bank officials err on the side of caution with policy changes. Stick around, we're celebrating St. Patrick's Day. That's early next on Asking for a Trend. Well, St. Patrick's Day, one of the biggest drinking days of the year, of course. It's on Tuesday. So we brought in local bar owners from here in New York City to talk expectations for this weekend and into the spring and summer. Joining me now are Mike O'Sullivan and Dan Grace, the owners of the bars Hartley's, Grace's, and All and Sundry. Fellas, welcome to you both. By the way, you've both set a new standard for guests, because not only do you do the show, not only do you come to the studio, you even bring beer with you. You bring Guinness.
We brought our profits.
That's the new standard. Walk me through this, just to begin, Mike. A little bit about the bars you guys run, the history. How did you get into the business?
Yeah, so I moved over here 15 years ago in March. Myself and Danny had known each other in Ireland playing rugby in Limerick. And I got straight working in bars. So I was working managing bars, and then we kind of lived together and we came up with the idea of going out and opening our own bar. So we opened Hartley's in Brooklyn 10 years ago this past December. So we have 10 years there. We wanted to build a neighbourhood. One of our partners, Jimmy, who opened us at the time, he's since gotten out of the industry. He lived in that neighbourhood and he said there was no neighbourhood bar. So he wanted to bring a real neighbourhood bar to Clinton Hill in Brooklyn. And then we did that. We were working in it. And then Grace's came along 2.5 years after. And then All and Sundry came along in 2022 post-COVID. So that was a different concept. It was more of an American concept, but basically just bringing warmth and Irish hospitality to neighbourhoods and trying to make these bars where people can come and just communicate and mix and gather and celebrate and whatnot.
Dan, how tough was that to get a bar up and running in New York City? I've never been to small business store, but I always assumed like a lot of paperwork, red tape, bureaucracy, or no?
Yeah, there is. Look, one of the hardest things for us anyway initially was to be able to actually get into the industry, not having come from a big company, come from other investors. We did it ourselves. So that was one thing. But the red tape is a lot. I think the city has gotten better over time. It was very hard. You have to get a health license. You have to get your liquor license. You have to speak to the local community board. There are a lot of different steps you have to take. But as I said, it is getting easier.
Mike, there was this proposal, I don't know if you saw this, I'll get your take, as a small business owner, to raise the minimum wage in New York City. Did you see this? To 30 an hour, that would be up from 17. What would that mean for you guys?
So I did see that. Our other partner in All and Sundry, Sophie, is a member of the New York Hospitality Alliance, and they are an advocacy group for the industry. It would mean a lot. Like you talk to any front of house person who's a tipped employee at the moment, they don't necessarily want to go on a flat rate. They enjoy being on the tip credit wage and actually being able to earn much more. If that came in, we would have to cut positions, which you'd have to do layoffs. We would have to, because you'd have two people. Now, we want to pay. We want everyone to make the most amount of money they possibly can. Our back of house who are non-tipped, we pay them much more than the minimum wage. The tip credit is one that I think anyone who's working. I was a bartender. That was what I did by trade. I came through this. We if you got rid of unlimited tips, people would make less, and we'd actually have to cut the lower paying jobs, which is something we'd never want to do. That's one that we do worry about a lot. And again, we want everyone to make as much money as they possibly can, but it wouldn't work. The finances wouldn't work for us.
Dan, talking about St. Patrick's Day, it's on deck. For you guys, how important is this? I mean, how does it compare to, New Year's Eve, Super Bowl, other events? Is this the big one?
Yeah, I guess it is the Irish Super Bowl. Yeah. It's our biggest day back home. It is a national holiday, and obviously here it's become, it's tied in with with our famous drinking culture. These days it's a week. Last year it was on a Monday, so we got the entire weekend and into the Monday, Paddy's Day. This year it's a Tuesday. So yeah, we're hoping basically as of today, maybe yesterday it all started, and to run the whole way through the week and make it basically our biggest week of the year.
Mike, I'm curious who your average customer is, the average demo. The reason I ask is because you do hear this anecdotal evidence, younger Americans, they're not drinking like they used to. Do you see that?
I think it's more of a trope sometimes. I think a lot of the Gen Z, I was reading a good article, they actually, they drink, but they don't have the money to drink as much as other generations. So in our bars in Hartley's Grace and all that.
You think a lot of it comes down to money?
I think so. I think it is a tough time, and I think that because we look at Grace's or All and Sundry, Hartley's, we have a mix of everyone. We've built classically, bars are very traditionally designed to span age groups, and we get them in. They don't spend maybe as much, but again, they'll age into their careers and over time probably earn more, and they'll probably be drinking more. But on a Saturday, on a weekend, we'd have a mix of everyone: Gen Z, Millennial, Gen X, and I feel like we've never designed our bars to target a TikTok generation, or we've a very traditional model that's design wise, and we feel that they come in, they enjoy it, and over time I think as their careers progress they probably will enjoy it a bit more, but they are in there, they are out. They mightn't drink as much as we did when we were that age, but I do think a lot of it is financially too.
I want to end here, fellas, because you were generous enough to bring me the beer, and we were talking off camera, and you were teaching me what it means to split the G. So maybe walk us through, what does it mean to split the G, and then how do we do it?
Yeah,
Danny,
the serious stuff. Yeah. So speaking of trends, it's hot right now. I mean, it's going a couple of years. Essentially, you want to take the first sip and you want to land it, splitting the letter G on the Guinness through your first sip.
Yeah.
with enough practice, you can get there or thereabouts. You can be lucky first time. I'm hoping you will. But it's
now,
fun.
Is this an
it's
Irish
fun.
thing, or what is this?
No, it's worldwide. You know, it may have even been more American.
Probably, apparently England and it started in Ireland, but I think that Guinness's probably secret marketing division is behind pushing.
Right now. That would make sense.
They're not stopping.
They're doing good work. Well, let's try splitting the G, gentlemen.
How about that? Cheers.
All right. What's the Irish cheers, by the way?
Sláinte.
There you go, sláinte.
Cheers, Mike.
Cheers. Oh, I'm way off.
Oh, I'm off.
Oh, I'm not too far.
Who got
off.
closest?
Not too far. Oh, we're close.
Oh, we're pretty good. I mean, I did okay for an American.
Yeah, you did.
I really did.
You did.
The only thing
I spilled a little. So.
Yeah, well, that's fine. This set could use. The only thing I ask next time, fellas, next time we do the Irish whiskey.
Oh, absolutely.
Absolutely.
Middleton from Cork, where I'm from, and Redbreast, 12, 21 15 are the best whiskies in the world.
It's the best whiskey
I think
in the world.
this should really just be how we end the week every week on the show.
Yeah,
this is really
pencil us in.
Thank you, fellas. It was so generous.
Thank you very much.
Thank you.
Pleasure.
Thank you.
Thank you so much.
That's a wrap on today's show. Thanks for watching. Have a great weekend. That was phenomenal, fellas.
Oh, I went to the handshake.